Welcome to the Hughes Optioneering Weekly Workshop, where we scientifically engineer trades for greater profit potential. This is the disclaimer slide. You can pause to read it. We're going to move on. Today we are going to look at BEKE, or B Holdings Inc. BEKE is a real estate company. It provides platform for housing transactions and services. KE Holdings Inc. is based in China. Here's the barchart.com technical opinion rating for BEKE. The bar chart rating is an 88% buy with an average short-term outlook on maintaining the current direction. Long-term indicators fully support a continuation of the trend. According to the Prime Trade Select rules, a stock is in a bull trend on a monthly basis if the stock price is above the 10-period or 10-month simple moving average. The monthly chart shows that BEKE is above the moving average line, so the monthly trend in BEKE is up. Next, we're going to look at a daily chart that displays the 50-period or 50-day exponential moving average and the 100-day exponential moving average. The blue line is the 50-day EMA line and the green line is the 100-day EMA line. If the blue line is above the green line, the daily trend is up, so the daily trend on BEKE is up. Now we're going to look at a daily chart that displays the Keltner channel. As a rule, we don't want to buy calls if the stock price is above the upper Keltner channel line. Anywhere inside the Keltner channel or even below the Keltner channel is fine. BEKE is below the upper Keltner channel line, so BEKE is inside the buy zone. Since the trend is up, we want to buy a call. BEKE has plenty of option chains to choose from. We're going to use the April 17 chain. Right now, the April 17 options have 44 days to expiration. Here's most of the BEKE option chain for April 17th. BEKE closed at 22:11 on Friday. That means any calls on the list from 5 to 22 are in the money. Let's take a look at the profit potential for purchasing the April 17, 22 strike call. The 22 strike call is the closest strike to the current price of the stock. The bid-ask for the 22 call is 2.16, 2.31. We try to enter at the midpoint, so we'll use 2.25 as the buy price. Our call option calculator shows the profit potential for this call based on BEKE price changes at option expiration from flat to a 12.5% increase in price. We can see that if the BEKE stock price is flat at 22.11 at option expiration, the 22 call will lose 95.1% of its value. Ouch! This is an unacceptable risk. That kind of loss can wipe out a trading account in a hurry. We developed what we call the 1% rule to help us avoid this kind of risk. The 1% rule says to limit the time value portion of the option we buy to 1% of the stock price. That means the stock only has to move up 1% for the call option we purchase to break even and start profiting. Now let's take a look at buying the 18 strike call to see if it qualifies for the 1% rule. Here's the call option calculator picture for the 18 call. According to the 1% rule, we want the call to at least break even if the stock price is up 1%. The calculator picture shows that if the BEKE stock price is up 1%, the 18 call will lose 5.8% of its value. We want that to be break even or better, so the 18 call does not meet our requirements. Let's see if the 15 call will work. The bid-ask spread for the 15 call is 7.15, 7.35. We try to enter at the midpoint, so we'll use 7.25 as the buy price. The 15 call works. If the BEKE stock price is up 1%, the 15 call will make a 1.1% or $8 profit. That's better than break even, so the 15 call is the one we'll buy. The call option purchase calculator also shows that if the BEKE stock price increases by 2.5%, the 15 call will make a 5.7% or $41 profit. If the BEKE stock price increases by 5%, the 15 call will make a 13.3% or $97 profit. If the BEKE stock price increases by 7.5%, the 15 call will make a 20.9% or $150 profit. The 10% and 12.5% numbers are also displayed. You can see that the profits get better and better. And notice that if the BEKE stock price does not make the expected move up and remains flat at expiration, the 15 call would only lose 1.9% or $14 compared to the 95.1% or $2.14 loss for the April 17, 22 strike call that we looked at earlier. Now we want to review a call option debit spread, aka a vertical call spread. For this spread, we want to buy to open the April 17th 15 strike call and sell to open the April 17th 20 strike call. We're going to base our entry prices on the midpoint between the bid and the ask prices. That means we'll buy the 15 call for 7.25 and sell the 20 call for 3.25. 7.25 minus 3.25 equals 4.0. So the entry price or debit cost for the spread is $400. The call option spread analysis calculator picture shows that the spread will make a 25% or $100 profit if the BEKE stock price declines by 7.5%, remains flat, or increases in price when the options expire. Creating the debit spread will allow us to collect a $325 cash credit to our brokerage account for the sale of the 20 call. As we said on the previous slide, this reduces the cost of entering the spread to $400. Here's a note regarding earnings reports. The next BEKE earnings report is scheduled for March 13th. Trend and momentum point to a further advance. Be careful out there. Let's review the trades one more time. The first trade was a call purchase. It said to buy to open the BEKE 15 strike call for 7.25. We also reviewed a spread. The spread said to buy to open the BEKE April 17-15 strike call and sell to open the 20 strike call at a debit of 4.0. That's it for this week's Optioneering workshop. Thank you for joining us. We look forward to seeing you again next week.